Live from the Champion Energy Studios.
It's time to engage you.
There's no reason to take on market risk right now until we get past Brexit.
Inform you.
It almost sounds like breakfast.
And entertain you.
Once we get past breakfast, we're going to be great.
Covering your world from economics to money to politics.
Brexit breakfast.
But
think of the possibilities.
IHOP should be all over this.
IHOP should be.
The Brexit breakfast.
The Brexit breakfast.
Call Lance now at 281-558-5738.
They'll bring your breakfast to you, but they're going to chop it up into 8 pieces and serve it to everybody else in the restaurant.
And you get none of it.
That's right.
But you get the bill.
Right.
The Lance Roberts Show.
I love it.
And they're going to rename the parking lot while you're inside.
Welcome to the Real Investment Advice Raincheck Economic Summit and Summer Outlook for the upcoming presidential election and your money. I'm your host, Lance Roberts, and I do thank you for being here today and spending this next hour with us. So I want to start out talking about something that I think is very important for most of you. The current market, as it seems, is simply very confusing, and I've got a chart here that should clear it up entirely. As you can see, of course, things are never quite as clear as we expect them to be, and everybody's got a different opinion and a different outlook. So what we're trying to do is to come to an understanding about not only how markets work, but what drives the underlying markets, whether it's technicals or price action or some type of fundamental issue. We're going to go through these things today. And when it comes to investing, it's always very important that you trust your gut. But not really, because as we've talked about before many times on the show, is that putting your emotional impact into your investment management always leads to bad outcomes. So we want to step aside and we want to separate out what our emotional biases are and focus on the facts that are actually driving the markets themselves. So the question really becomes now, who is going to be best for the stock market? You know, if you listen to a lot of conservatives, you find completely different opinions about the presidential nominee at this point, Donald Trump, as president and his impact on the economy. There are some conservatives out there that are saying he's not the right guy and we need to get somebody else. Now, on the other side, on the Democratic side of the ledger, we've got people saying that Hillary Clinton is the best choice. But for you as an investor, let's set aside the politics for a moment and let's talk about what is truly important when it comes to investing. It's not about who is driving the boat, but it's about their policies that they are potentially going to implement that have an impact upon the financial markets, because it's about the economy, stupid. This is really what it comes down to. But policies matter. And depending on who you're looking at and who your preference is for the upcoming presidential selection, Clinton has a very specific platform. Hers include an anti-Second Amendment issue, government-controlled health care, expansion of immigration, raising the minimum wage, pro-legalization of marijuana, supports climate change, legalizing abortion, pro-LGBT, transgender rights, increasing taxes, anti-Israel, pro-Iran, ISIS, no boots on the ground, and supports a form of the Trans-Pacific Partnership. If you take a look at a lot of her policies, while they are said to be democratic in nature, they're actually more socialistic in nature. When governments control wages and prices and structure, that is in and of itself how socialist governments operate. Let's take a look at Trump's platform just as a comparison. And it's simply a mirror image of what Clinton currently proposes. Pro-Second Amendment, repeal, replace Obamacare, build a wall, immigration reform, U.S.-China trade reform, focus on job creation, reform of the Veterans Administration. Climate change is a hoax, limit abortion, same-sex marriage is a state issue, lower tax rates, pro-Israel, anti-Iran, ISIS, no boots on the ground, but opposes TPP. So very similar in nature in some areas, but very diametrically opposed in others. And of course, the question becomes, which one will implement the policies that are best for the economy going forward? What will put more people back to work? What will raise wages overall? Which will increase more tax revenue even though you lower tax rates? These are the type of questions that we need to be asking, because this is what the markets and ultimately your investments will respond to. This chart that I'm showing you now is what happens to the market. It's an average pre-election year. This is the year we're in right now, the pre-election year of the S&P 500. And this is the average return of these years going back to 1960. And what we find is that on average, because, well, Wall Street's not certain about who's going to get elected and what policies they might implement, we find that the average return of the S&P falls by about 2.7% on average. On a pre-election year during secular bull markets, this is a very different issue. If we are in a secular bull market, as we were in the 80s and the 90s, the average return during a secular bull market for a pre-election year like we're in now has been about 12.2%. During a secular bear market, as we are in now, and this started at the turn of the century, the average return has been down 6.9%. So no matter really how you slice this at this point, the risk to the markets currently, really no matter who's elected at this point, is to the negative, simply because of valuation levels and because of potential risks that are already currently built into the market in terms of excesses. But when we take a look at the average post-election year as to whom gets elected, and they are now entering office on January the 20th of 2017, the average post-election year for the S&P 500 has been up 11%. Now, that's a little bit deceiving because we're only looking at one specific year given through both secular bull and secular bear markets. So if we structure these out and take a look at the differences between bull market periods and bear markets, we also find that during bull markets, during secular bull markets, again, like the 80s and 90s, the average return was up about 20% versus just 8% during a secular bear market. But even that's a bit deceiving because this, again, is an average of years. And if we go back and look at specific return years of certain Democratic and certain Republican presidents, we find much varied returns, both positive and negative. So at this point, it really comes down to whom you expect will give us the best rate of growth, economically speaking, going forward. And what we find here is something also interesting. This chart shows you every Democrat and every Republican president going back to Truman. And what we find is that during Democrat years, the average rate of return has been positive. And it's only during Republican years, Nixon and Bush Jr., that we see negative market returns. And why is that? Well, if we take a look at, for instance, when Clinton was in office, he did a lot of stuff that benefited basically from Reaganomics that helped boost the economy in the 90s, even though really much of Clinton's policies in the late 90s really didn't have much to do with actually creating economic growth. He rode a great tidal wave of Reaganomics, but actually did not much to create actual economic growth, which is why when he left office, the excesses that were already built up, and while everybody points to Bush and talks about 9/11, the reality was, if you'll remember, that as soon as Bush walked into office, he was dealing with a recession, the fallout of Enron and WorldCom and Global Crossing and a variety of other companies that were rife with economic and accounting scandals because of the rules and policies that had been put into place during the Clinton administration. As with all things, it is the policies of the previous president that typically show up in the next presidency. So one thing that we really need to be focused on here is that we're 8 years into an economic advance. That's very long by historical standards. This is the third longest economic expansion since 1850. And the reality is that we are very likely much closer to the next recession simply from a function of time and excess buildup in the markets than not. So the bottom line here is it really may not matter who's elected president. The recession that's likely coming will show up and manifest itself sooner rather than later. So who's better for the stock market really? That's the question. The truth is that it probably won't matter. The problem is that the long expansion of economic buildup, ongoing Fed interventions, excess liquidity are likely setting us up for a rather nasty economic recession and financial fallout within the next 18 to 24 months. What hath the Fed wrought? This was something I went through in a lot more detail in the live event, but there's a couple of points that I did want to bring up because of what's happening with Yellen's interventions into the financial markets. But it's not just Yellen, by the way. This is something that started under Ben Bernanke back in 2009 with QE1, QE2, QE3, and we've boosted asset prices by 200%, not driven by economic growth and relative strength and revenue growth for companies, but by liquidity interventions directly into the markets that did nothing but actually drive asset prices higher. If we take a look at some of the recent statements by Fed Chairman Janet Yellen and previous Fed Chair Ben Bernanke, Bernanke says that we are lucky to have Yellen leading the Fed. Yellen says America owes Bernanke an enormous debt of gratitude. Yellen says we want to do everything to head off a financial crisis. But the problem is that everything that we're currently doing by inflating asset prices without underlying revenue growth and corporate profitability is simply setting us up for the next financial crisis. So, in fact, by saying that they don't want to create a financial crisis, everything they're doing is actually leading us right to the next financial crisis, just as what happened in 2007 and early 2008 under Ben Bernanke. In fact, Ben Bernanke said in June of 2008 that there was no recession in sight. Well, we all know how that turned out. This chart shows the Fed balance sheet. This is something that's talked about a lot, the expansion of the Federal Reserve balance sheet by over $4 trillion since 2009. Prior to 2009, the actual Fed balance sheet ran between about $60 million and about $180 million. That was excess reserves sitting on the balance sheets of banks for overnight lending purposes. Beginning in 2009, that number exploded to $4.2 trillion over the course of the last 8 years. Now, what we find here, though, is that there is a very direct correlation between advances in the Fed's balance sheet and the underlying S&P 500 index. Makes perfect sense because that's where the money goes. One of the misconceptions is that the Federal Reserve is printing money. They're not printing money. What they're doing is buying assets directly from the banks. It's a digital transaction. The Federal Reserve buys the bonds from the banks by crediting their excess reserve account at the Fed, which the banks can then use to either lend out or do something else with. The intention is that by buying these bonds, the banks would then make loans to individuals to buy houses, start businesses, etc. But why on earth would the banks loan money at 3 or 4% interest when they can simply plug it into financial assets and leverage that through the yen carry trade or through a variety of other leveraged instruments and increase much higher rates of return? Or better yet, buy junk-related debt from countries like Greece, knowing that even if Greece blows up, they're going to get bailed out by the government again. Get a lot higher rate of return with no risk versus you actually paying your loan back, which typically doesn't happen in the event of a crisis. So what we see here is this very direct correlation between expansions in the Fed's balance sheet and, of course, the S&P 500. And notice since the beginning of 2015, the market really hasn't gone anywhere because the size of the Fed's balance sheet hasn't gone anywhere. And the question really becomes, what's going to drive asset prices higher as we go forward? As you can see here, the markets were rising in 2009 until the Fed stopped QE1. The markets then went nowhere. Same thing in 2011, when QE2 stopped, the markets declined by 20%. And this is where we are now. Ben Bernanke jumped in with QE3 in anticipation of a problem with the fiscal cliff due to the 2011 debt ceiling default debate. But since it never occurred, the actual fuel into the financial markets created an asset bubble in asset prices, even though there's nothing driving underlying revenue growth. Since 2009, revenue growth has grown in total by about 33% versus corporate profits, which have grown by almost 240% due to accounting gimmicks, share buybacks, and the impact of using liquidity to their advantage. Market trouble ahead? Probably. It depends on what the Fed does next. The real importance, though, is that ultimately stocks cannot outgrow the economy for very long. Historically speaking, going back to 1900, the economy has grown on average by about 6%. Of course, it's not surprising to find out that the capital appreciation of the stock market has also grown by about 6%. The reason for that is that companies can't grow faster than the economy because they are a reflection of the economy, particularly in an environment where 70% of the economy is driven by personal consumption expenditures. In other words, the stuff you buy at companies like Target, like Walmart, are what drive the revenues of those companies and the profits. So ultimately, at the end of the day, the market is simply a reflection of the economy, not the other way around. As you can see here by this chart of real GDP versus the Fed's balance sheet, there's been a very close correlation between the size of the balance sheet and the expansion of economic growth. Mind you, this has been the weakest rate of economic growth ever in the history of the United States. QE1, did provide a push to economic growth from a deeply depressed state, but I would argue that even without QE1, the economy would have rebounded from the depths of the financial crisis in 2008. During QE 2, 3, and 4, there's not been much of an impact between expansion of the Fed's balance sheet and actual economic growth. In other words, there's been a diminished effect of return from each dollar of QE as it relates to actual economic growth. And this is because the money actually never went through the main part of the economy. It stayed bottled up within the top 10% of the economy, where people that had assets already and had wealth had money to actually invest in the markets. For the other 90% of the economy, they are actually worse off today than they were 8 years ago. But let me show you an effect in dollar terms. As you can see here by this next chart, the QE effect relative to the S&P 500, the total percentage increase in the Fed's balance sheet was 382.36% versus a total increase in the S&P 500 since the depths of 2009 of 209%. In other words, it took $1.82 of Federal Reserve balance sheet expansions to create $1 worth of growth in the S&P 500. When we take a look at the effect of the Federal Reserve's balance sheet expansions as it relates to economic growth, we find it took $14.10 worth of QE expansion in order to create a dollar's worth of economic growth. It's not really a good trade-off by any measure. When we take a look at employment, it's actually worse. It took $47.16 of Federal Reserve balance sheet expansion to create $1 worth of employment growth. How about those people that are no longer part of the labor force? That was actually a better deal. It only took $22.83 to quit counting people as part of the labor force. Let's talk about the zero bound effect. And one of the latest pieces of conversation and really kind of worries for the financial markets are the impact of negative interest rates. We're seeing now more than $10 trillion worth of assets around the globe now trading at negative interest rates. To put this into some context, the total economic growth of the entire planet is around $55 trillion. In other words, we have almost 1/5 of the value of the entire world's economy trading at negative interest rates. But the reality is that negative interest rates aren't a good thing. Interest rates are a direct reflection of the overall economic environment. And as you can see here, over the course of the last really 50 years, every time the Federal Reserve has intervened into lowering or raising interest rates, as they're currently trying to do now, it's repeatedly led to either a financial crisis or an economic recession or something worse. Whether it was Continental Illinois, the savings and loan crisis, the Orange County, California bankruptcy, the dot-com crash, the credit crisis, or whatever's next. So what is the zero bound effect actually telling us now as it relates to the financial markets? Here's some warnings that you really need to be paying attention to. These are the things that I was watching back in 2007 when Ben Bernanke and others were saying there was absolutely no recession in sight. In December of 2007, I wrote that we were either in or about to be in the worst recession since the Great Depression. Well, at that time, everybody laughed at me and said that's not the case because the economy is still growing. As I said earlier, even in June of 2008, Ben Bernanke said no recession in sight. As I said also, we know what happened next. But when I started looking back at 2007, I wanted to see if there were some things that we could see then that are happening now. So let me show you a few of the warning signs that I'm taking a look at. First of all, let's take a look at profit margins. Throughout history, real profit margins, now, these are profit margins that have been adjusted for inflation over time, and this is compared to the actual inflation-adjusted return of the S&P 500. As you'll notice, each time that profit margins peaked and began to fall, the subsequent recession was not too far to follow, and also the subsequent decline or problems with asset prices. Just like we saw in 2007, we're now seeing the early stages of this once again as profit margins begin to decline. The second thing is valuations. While we talk about PEs quite a bit, price to earnings, the problem is that earnings are highly manipulated today through accounting gimmicks, stock buybacks, distributions, etc. The only thing that we can really know for sure that is happening with companies is when we look at the top line called revenue or sales. Sales are hard to manipulate because it's simply what did I sell and what did somebody pay me for it, and that comes in at the top line. Then, of course, through the income statement and through accounting manipulations, I then subtract out cost of goods sold, I take accounting deductions, I write off certain things, and I get a much better bottom line looking in terms of earnings. But again, sales are hard to manipulate. And if we take a look at sales and divide that into the price of the stocks of the S&P 500, we are at the second highest level on record ever in history of price to sales. Price to sales are expensive by any measure. This is also something that we saw happening in 2007, also a big warning sign in 1999. But as I said earlier, it is the economy that is what drives stocks and, of course, profits over time. While it is often said that the stock market leads the economy, it's really not the case. It is only because in hindsight that we get negative revisions to economic data that we find that the stock market is more coincident with economic growth and economic declines. Currently, when we take a look at the economic data, we are operating at the lowest level of economic growth that we have seen in the past, really 15 and 20-year periods. In fact, we are operating at levels that are more normally associated with recessions already, rather than expecting one to occur in the months ahead. Equity ownership is another problem. What we see at the peaks of bull markets is high levels of equity ownership. This is because most individuals acquire equities with the expectation that markets will continue to rise indefinitely. That exuberance, that emotional bias that we talked about earlier, is what leads to excess equity ownership as the continued expectations of future returns override rational expectations and fundamental realities of what's happening in the markets. Currently, equity ownership is at the second highest level on record. Again, something we saw back in 2007 was a rapidly expanding rate of equity ownership that signaled the end of that previous bull market cycle. Same thing in 1999. It's also very interesting that in this current cycle, we see something that hasn't occurred since the late 70s. Back in the late 70s, everybody was buying blue chip dividend-yielding stocks. It was called the Nifty 50. It was the 50 largest blue-chip stocks on the index, and everybody wanted to own them. That was the place to be because, well, you would never get hurt owning a company like Coca-Cola or McDonald's or IBM. The problem is that you did get hurt when the Nifty 50 crashed in 1974. Since 2009, it hasn't really mattered that you've owned small cap or mid cap stocks or even the S&P 500. Small and mid cap are the most aggressive forms of stock equity ownership because they have low capitalization rates. But basically, if you wanted to outperform any market anywhere in the world, all you had to do was own the S&P 500 dividend-yielding stocks. That current rate of growth has outpaced small cap, mid cap, the S&P 500 index itself, international and emerging markets. In other words, chasing dividend because of the zero-bound world that we live in has led to a gross overvaluation of dividend-yielding stocks. The safety of being in a blue-chip dividend-yielding stock is gone. In fact, during the next financial crisis, this is one of the areas that is likely to get harder than any other sector of the market. As we talked about earlier with price to sales, I was telling you about earnings. Earnings also are on the decline. As we take a look at earnings historically, earnings have always peaked and declined relative to the market itself. This time, asset prices are being elevated by ongoing central bank interventions and verbal easing by the Federal Reserve. The problem is that the disconnect between prices and actual earnings is likely to play catch up when you least expect it. Those are the warnings that I've been looking at. These are the same things that we saw at the peak of the last two major bull markets. Are these a guarantee that the markets will decline and we'll have another major market crash in the months or years ahead? No, nothing is guaranteed in the market. But using history as a guide, the risk of equity ownership is potentially far outweighed by the risk of reversion, which is currently being shown to us. So let's shift topics here for a moment. We've talked about the risk of a financial crisis coming. We've talked about the risk of market reversions. But let's talk about the truth about investing and really why this idea of buy and hold doesn't work. And this has to go basic to the premise of what you've been told by the financial markets is a lie. Let me show you exactly what I mean by that. It's often said that the markets grow at 7% on average over time. Simply put your money into the market and just don't pay attention to it. And over time, you're going to be just fine. You'll make 7% on your money or more. And a lot of the financial calculators online that tell you want to plan for retirement, just plug in a number. You get 7% a year every single year until you retire, and boom, you're richer than Bill Gates. The reality is that it doesn't actually work that way. What this chart shows you is the real returns of the S&P 500 in green going back to 1965, and assuming that you started investing back in 1965. Well, today, yes, you would have made money in the financial markets, and yes, they would have grown on average at about 7%. If we extrapolate historical rates of return into the future, what we see is a very similar market environment moving forward that grows at about 7% on average. The blue line shows you what 7% compounded on an annual basis looks like versus what really happened to your money in orange. The yellow shows you the gap between what you're told is going to happen, the 7% every single year, versus what really happened with your money. The problem is that gap is the difference between you retiring successfully and not. And this is what's never told to you by the financial media that simply wants you to put your money in so they can charge you a fee and not actually have to manage it or work for it. Every year, Dalbar does a research study showing what investor returns look like over time. In the 12 months ended in 2013, when the markets were up nearly 32%, the average investor for that year only received a 25% return, underperforming the markets. In a 20-year period, they received 5.02% versus the S&P 500 yielding over 9%. What's the difference? The problem is that investors tend to repeatedly make one financial mistake after another based on emotional biases. They buy high, they sell low. They don't buy when they should. They invest in the wrong asset classes. They get told to buy gold versus this or that or something else. The reality is that we have to focus on what markets are telling us and invest our portfolios accordingly. More importantly, it's not about chasing the markets as markets rise that make us money. It's about the risk of losing money, particularly when there's an economic recession on the horizon. This table shows you every single recession going back to 1870. The important part about this table is what the average rate of return is through every recessionary period. As you notice, markets on average lose about 30% of their value during a normal economic recession. Of course, it's easy to say, well, 2008 wasn't a normal economic recession because of the financial crisis, but what about the dot-com crisis? What about the crash of 74? What about the crash of 29? Yes, every crash is always different, and there's always a reason why it's different, and next time will likely be different as well. The catalyst will be different, but the results will likely be very much the same. And here's the important point. What this chart shows you is the rolling 20-year annualized rate of returns of investments. Now, it's often said that if you just invest in the market, no market's ever lost money on a 10 or a 20-year basis. Well, it's not true. The problem is that those charts that tell you that are not adjusted for the rate of inflation. In other words, the devaluation of your money and returns by the cost of inflation. What you find out is that there are 4 periods throughout history, which are very closely linked with secular bear markets, where there actually have been negative rates of return over 20 years. In other words, you invest your money and 20 years later, you actually have less money than you started with. What drove those negative rates of returns? Not surprisingly, valuations. With valuations currently at the second highest level on record, I can only warn you that the next 20 years will likely be much more disappointing than the last 20 have been. But it's often said, but Lance, if you miss the 10 best days of the market because you're not invested, it really impacts your overall rate of return. And that's a very true statement to be made. What this chart shows you is what happens if you miss the 10 best days of the financial markets by not being invested. But what Wall Street doesn't tell you is what happens if you only miss the 10 worst days. Your rate of return is substantially better. It's not about chasing markets when they rise. We can always make money when markets are going up, but it's the point of not giving back our principal and destroying our principal when markets decline. Over time, the markets make new highs only about 5% of the time. The other 95% of the time, markets are spending, making up previous losses. And unfortunately for you, you won't live 130 years to make up those previous declines. You only have between today and when you need your money. And if that falls within a 20-year window, the risk for you over the next 20 years is going to be trying to create a rate of return to meet your goals in a highly volatile and risked environment. But Lance, I hear this all the time. But Lance, I can't hold my money in cash because cash doesn't yield anything. It's true. In a zero-bound environment like we're in currently, cash has a zero yield. But let me ask you a question. What's worse, a zero rate of yield on cash or a negative yield on an investment? See, the problem is that people immediately assume that we have some high rate of inflation that's going to eat away all of our future value. And if you're in cash today, well, my gosh, you're just going to lose all this money because over the next 20 years, you're not going to make anything. When I talk about holding cash, I'm not talking about holding cash for 10 years or 20 years. I'm talking about holding cash for maybe a few weeks to several months, depending on what's happening in the markets. Again, for me, a loss of capital is much more important than a zero rate of return. I can make returns on money when I invest it, but it's hard to spend all my time just making up previous losses. What this chart shows you is the S&P 500 going back to 1900 and the value of holding cash. Now, all I did is that every time the market got to 23 times earnings, and by the way, I don't really manage money this way, but this is for example purposes only. Every time the market got to 23 times earnings, I simply moved everything into cash and held it there at a zero rate of return and adjusted it for inflation. So as you see in the 1970s, when we had spiking inflation going up to 14%, yes, my cash actually lost money. But because during previous periods of time where I did not lose money during market declines and bear markets like in, the Depression era, I actually came out way ahead. Even since 2000, holding cash netted me a better rate of return than actually being invested primarily in the financial markets because I never lost money. So if I can spend less time making up losses, I come out ahead over time. Importantly, when we talk about managing money right now in this cycle, it's important about understanding where we are in the economic cycle. And through time, what we find out is that certain sectors tend to perform better at late stages of the economy versus early stages of economic growth. As we see here in this chart, healthcare, utilities, finance, energy staples, and healthcare are better performing sectors during late stage economic cycles and recessionary cycles. And what we see now is where the best performing sectors occurring currently, exactly in those areas, which is what you would expect in an environment that is a late stage economic cycle. So when it comes to managing money, I believe in something, keep it simple. My father used to always tell me about the KISS principle, keep it simple, stupid. Well, this is a late-stage economic cycle. We don't need to be complicated with our investment strategy. We just have to understand where money is most likely to be made, allocate assets accordingly, and control the risk. So a simple model for a late-stage cycle like we're in now is 35% fixed income. Why? Because if I buy bonds that mature at face value, I have no risk of principal. I create a stagnant rate of return. I know today, as soon as I buy a bond, exactly to the penny what my future return will be. My cash, yes, it yields nothing, but it gives me opportunity and it gives me liquidity if I need it without having to be forced to sell assets in case I need to meet a family emergency. As far as the equity side of the portfolio, a focus currently, right now, on dividends, staples, healthcare, utilities, and selected blue chips. That makes up the 60% of the portfolio. Now, of course, if you follow the model that we publish in our weekly newsletter, well, we've currently got a reduced level of equity risk. I'll go into that in a second. And yes, dividend yields, as I said earlier, are one of the highest risk areas of the markets when the markets begin their next major correction. But right now, that is where money's being made. And the dividend yield provides some income into portfolios as well. So this is the value of risk management, though. As I said earlier, you wouldn't be allocated 60% into equities currently. You would only be at 30% based upon the value of our risk management. What our indicators tell us currently is that risk is elevated in the market, so I don't want to be holding a lot of equity risk exposure. I want to be holding more cash at this point. Look, the markets haven't gone anywhere since May of 2015, so holding more cash at this point has played to my benefit by lowering volatility of the portfolio and still allowing the income from dividends as well as interest income from bonds to increase the value of the portfolio. As I show you in this next chart, the question I often get is, well, Lance, you're missing out on the markets. The markets are going up, and ever since February, there's been all this money made. Let me just be honest with you. Nobody bought the bottom in February. Nobody bought the bottom last August because why? They were already allocated, and they're just trying to make up losses. So the value of risk management, where it really plays into, is controlling the risk of principal. Again, as I was saying earlier, if I spend all my time making up previous losses, well, I'm really not making any advance towards my retirement goals. So the question generally becomes, but Lance, if you're not invested, you're missing out. Since the bottom in February, there's all this money that's been made in the market. Nah, that's true, but most people weren't buying the bottoms in February. They were simply panicking because the markets were declining. Now, they're just simply making up previous losses once again. But for us and how I manage money and my approach to money management is simply this, is that if I can lower the volatility risk, A, I reduce the emotional drag, and B, I make better returns over time by not having to make up previous losses. What this chart shows you is that since the beginning of January of 2015 is the difference between the index, my strategy, and what actually happened in the markets. And so did I miss anything over the course of the last year or so being only 50% cash? What this shows you is that a 60% stock, 40% model on a buy and hold basis grew to about $102,000, up from $100,000. Over the last 15 months, you've made a total of about $2,900 on your portfolio, as opposed to $2,100 by being invested on a risk-adjusted basis in that same model. In other words, by being 50% in cash and reducing risk, it is only about an $800 difference between buying and holding and actually managing the risk in the portfolio. And if I'd just been invested in the S&P 500, it's only $2,500 during that same time frame. So yes, the model, by risk adjusting it, is currently a little bit lower than what would have happened if I would have bought and held since January of 2015. But the reality is the differential in volatility helped people sleep better at night. And ultimately, if the markets had cratered in February or in August of last year and had gone down by 20 or 30%, the risk-adjusted model would be substantially ahead of the losses that would have occurred in other models. We can prove this by looking back at what would have happened following the risk management model going back to 1999. The blue line is a $100,000 investment into a 60% stock, 40% bond model going back to 1999. The red line is the exact same model, but just simply adjusted for risk following the signals that we publish every week in our newsletter, which you can find at the website, realinvestmentadvice.com. The difference is not that there's a substantial amount of outperformance by being a better asset selector. It is simply a function of avoiding the drawdowns when they occurred in the markets. Again, back in 2008, when I was saying it was time to get out of the markets and reduce risk, people were saying that that was simply not an issue and that the markets would be fine. Again, we know how that turned out, but that differential in savings of risk turned out to be a huge benefit long-term because it took a lot less time to regain the drawdowns that were taken in portfolios. The important thing here is that managing risk is far more important than chasing returns in the market. Having an investment discipline and a strategy to control your principal, control the risk, and create returns over time is what will ultimately lead you to successfully achieving your financial goals. Again, that's what we're in this for, is to make sure that you can reach your retirement goals on time and intact. The problem with buy and hold mentalities and these arguments that are made in the media all the time is that, yes, they work great during rising bull markets, but during declining bear markets, which occur on a regular basis, people tend to do exactly the opposite of what they should do. They sell out at the bottom, they don't get back in until 3 or 4 years into the next bull market, and the ultimate destruction of their capital over time is actually never recovered. Having an investment strategy and a discipline like I employ It's what will help you reach your goals over time. Will we beat the market every single year? Absolutely not. But what I can promise you is that over time, you will be able to reach your goals because you won't be spending the bulk of your time making up previous losses. I know one of the big issues for most of you is where is oil headed? What about gold? What about interest rates? Let me cover that next for you. What everybody wants to know right now, has oil actually bottomed? My expectation is that while we may have seen a long-term bottom in oil prices, the reality is that we're not likely to see a return back to $80, $90, or $100 a barrel anytime soon. The reason for this is that the supply-demand imbalance of oil is simply still out of whack. The last time that we had oil supplies at these levels was back in the early 1980s. Demand was rising, as currently as what is expected, but supplies fell from 1985 all the way through to 2009. Oil supplies were falling. Remember the whole arguments about peak oil and how we're all going to run out of oil and die? Well, it never actually occurred. And in fact, what happened was a fracking miracle in 2010 as oil companies discovered how to frack oil and bring it in boatloads, literally. And, of course, what happened then was this massive spike in oil supplies when demand really has not risen at all during that time frame. So, in other words, for oil prices to return back to the $100, $120 a barrel is not likely to happen anytime soon. And as demand has hit peaks, as we've currently seen, and by the way, as we continue to have weak global economic growth, it is unlikely that demand for oil will rise substantially. The reality is that oil prices may continue to stagnate for quite some time. In fact, as I show you on this chart here, the last time that we had the current level of supply-demand imbalance was, again, back in the early 80s. Oil prices remained confined to a $20 to $40 a barrel range for almost 20 years. So will we return back to 20 to 40? Well, maybe it's 30 to 50 or somewhere in there. But what we are likely going to find is that over the course of the next 10 or 15 years, as we continue to work off the supply-demand imbalance in a globally weak environment, that oil prices will be somewhat contained. Does this mean that oil companies can't make money? Of course not. They'll make money. But we're going to be in a different dynamic than what we saw previously, and likely we'll see oil prices return to trading within a range and trading more like oil companies should trade rather than actually trading like technology stocks as we saw between 2009 and 2014. One thing that is very interesting is we talked about the relationship between the Federal Reserve balance sheet and the S&P 500 earlier in this seminar. But look at the relationship between the Federal Reserve balance sheet and oil production. This is also not surprising as liquidity, as it was given to banks, banks were looking at places to make investments, and fracking was a great investment opportunity. They could make lots of money by loaning money to oil companies to go out and frack for oil. The problem is now that liquidity is dried up, and as the problems impact the fracking companies, there's actually a reduction in the amount of liquidity going to oil companies to go out to drill. This is also going to impact revenues, capital expenditures, and other issues that are going to relate to the financial markets for some years to come. Is oil at 50 a good opportunity? Probably not. What we see is currently is that we are well within a long-term downtrend in oil prices, and again, while we may not see new lows in oil prices, we will probably ultimately retest lows at some point either later this year or next year, particularly as we move into a recessionary period in the economy, because oil prices are now as overbought as they were at the peak of the oil market previously, and again back in 2015, and then late last year, 2015, just prior to the onset of further declines in oil prices. With commodity futures and commodity contracts now at all-time highs, it is very likely that we will once again see a reduction in oil prices as these things come unwound in the near future. So when it comes to making investments in the energy-related sector, I certainly suggest that you want to be cautious about how you invest and where you invest. Valuations for energy-related companies are at the highest level on records, which suggests that future returns on energy stocks are going to be fairly muted. Let's talk about gold. gold is a function of expectations about inflation and economic distress. I understand why people want to own gold. If you listen to the headlines, the world is about to end, particularly if Hillary Clinton or Donald Trump is elected. It's going to be the end of the world as we know it. Oh my gosh. Well, the reality is that gold is an emotional owned asset class. It is an asset class. That is it. It doesn't provide a yield. It is simply something you buy for price movement. At the end of the day, as I've talked about before, if you have a gold bar and you want to go down and buy a cup of Starbucks coffee, you can't do it. The reason is there's no medium of exchange in place any longer in this country to use gold as a function of exchange. Yes, if there's actually ever a major economic collapse, gold may actually very well be a commodity worth owning for bartering purposes, etc. But the reality is, in that environment, lead will be a much more preferable asset because if I own enough lead, I can get all the gold I want. And in an economic collapse, that is going to be more about self-protection than worrying about having gold to barter with. In the current environment, let's talk about reality for a moment. Gold is simply an asset class that moves up and down and is fairly volatile in its nature. The recent concerns about economic weakness, etc., and of course what's happening with the Brexit issue has driven gold prices up in recent times. But once those crises pass, and they will, gold will likely continue its decline until such point as we actually see real inflationary pressures, real economic concerns as we potentially head into the next economic crisis. But that may be a while off yet, and we'll know well in advance of that occurring, and we'll know when to add gold as an asset class to portfolios. It is something you trade. It is not something that you own. This is just my opinion. You are certainly welcome to go and own gold in the physical form as long as you want, but the problem is that when it comes time to sell gold in its physical form, and you actually get down to the gold dealer to actually sell it, well, basically everybody else will have already come to the same conclusion, and prices will fall so rapidly at that point that the value that you get for your gold won't be what you expect. It's what always happens. So be careful owning physical gold. It's not as cracked up as a lot of these commercials tell you it is, and the reality is that ultimately we're owning an asset class to make money. That's it, no more, no less. Let's talk about interest rates. As we addressed earlier, interest rates have approached zero and negative almost in every country around the world except the United States at this point. But what do low interest rates tell you? Interest rates are a direct reflection of economic strength. As this chart shows you, whether we look at gross domestic product, inflation, the 10-year treasury rate, or even the velocity of money, what interest rates tell you is that the world economy, and particularly in the U.S., the domestic economy, is extremely weak. Low interest rates as a measure of value or as a measure of economic strength tells you that we have neither. But I will tell you this. We are in an environment where we are likely going to be trapped within low interest rates for the next decade, maybe longer. If you don't believe me, simply go take a look at Japan. Low interest rates and negative interest rates, again, as a function of economic growth, suggest that we're not going anywhere anytime soon. But owning bonds can be an opportunity to make money also. Just like you buy stocks in expectation of the S&P 500 going higher, we buy bonds in the expectation that interest rates are going lower. And in an environment where interest rates are simply trading sideways and moving in a range between 1% and 2%, we can actually make a good bit of money by owning bonds when rates are near 2% and selling bonds when rates are near 1%. We're going to have to be more proactive about owning bonds in our portfolio. The last 30 years have been great. We could simply buy a bond, watch interest rates fall, and watch the value of our bonds rise. Those days are over. The value of owning bonds today are going to be simply for protection of principal, generating interest income, but we're going to have to manage our bond exposure to also enhance yield by adding a component of capital gains management. I want to thank you for spending some time with us today. And of course, I'm always open to take questions and comments from you. Simply go to realinvestmentadvice.com, click the Ask a Question button, and ask whatever you want. I'm always happy to help you out. I hope you found the information of today's webinar beneficial. And of course, we'll have another live event coming up soon where we can go more in depth into these issues. But as always, in the meantime, if you need to ask a question, would like to schedule an appointment, take a look at your financial plan and the assumptions that you've made or that somebody's made for you and get our opinion on it. We're happy to do it for you. Simply go to realinvestmentadvice.com, click the Ask a Question or the Schedule an Appointment button. Let us know how we can help you. We're here to serve. We enjoy doing it, and we're always here for you. realinvestmentadvice.com. Thank you again for joining us today, and we'll see you at the next webinar in July on investment guardrails.